Okay.
It's rare that I get the musical introduction, so it's kind of flattering. There are really a few things that I'd like to talk about today, but the theme of the presentation is, how do we make money in these markets? I think what investors want to know is not just about how do stock markets grow, how do our portfolios grow? How do we make some money? And really, I think there are four big problems with stock markets right now, and the question is, what are the problems? What do we need to look for? How do these problems turn around and become positive factors? So there are four things going wrong right now that might start to go right pretty soon. Let's look at the first one. The first is obviously the European crisis. So we've got the prospect of Greece exiting the euro. And really, I think when we're worrying about the Greek exit, what we're really worrying about is Spain. Because we know that the day that Greece leaves the eurozone, that's the day that Europe has to be prepared to replace the entire liability structure of the Spanish and the Italian banking sector. The day that Greece leaves the euro is the day that Europe has to find a way to fund the sovereigns of Spain and Italy. The bailout for Greece is the cheapest Spanish and Italian bailout that Europe has. Now, remember that this isn't the first European crisis that we've seen. When I was a kid, before there was a euro, there was a long tradition of Southern European countries having current account problems. And it used to be, when I was a kid, that your Spanish or your Italian banker would go to Frankfurt and tell their creditors, "We're sorry. We borrowed some Deutschmarks and some lira. Here are all the Deutschmarks back. They're good. Here are the lira, here are the peseta. They're not worth as much as they used to be. We're sorry." And this was considered socially acceptable. The current account surplus countries like Germany would lose a little bit of money. They'd get repaid less than in full, but it would go on. They'd lend again. We're now in a very different social dynamic. The Spanish banks, the Italian banks, the Greek banks, the sovereigns can't really go to Frankfurt and pitch up with 80 euro cents and say, "We're sorry, let's play this game again." It's the same economic outcome, trust me on this one. The Northern European banks lose a little more than they thought. But given that we're in the eurozone, the social dynamic is different. This is a default. This isn't just a devaluation, this is a default, and you can't do that. Now, remember how this crisis started. Remember, when you look at the current account deficit crisis of Europe of 2008 to 2015, that it started with private sector banks. The Irish banks borrowed a ton of money from the German banks, lent it on to private sector property developers. There's always a property crisis somewhere in these things. Lent it on to the property developers. Property developers had a big bubble, it all went bust. Irish banks went bust. Now, normally, and when I was in school, I learned how bankruptcy worked. You wipe out the equity holders, the sub-debt guys take a big hit, and then you go to the senior debtors, they get all the equity, and they probably get 75 cents. But that's not what happened this time. What happened this time is the Irish banks went to their creditors and said, "Sorry, we can't pay." And Europe told the Irish sovereign that Irish private sector banking debts must become Irish sovereign debts. Fast forward 2 years, Greek sovereign runs into problems. What happens? They go and say, "Well, we can't really..." No, what happened was Europe said, "We will lend you, Greece, the money as long as you repay the Northern European banks." We're now running into a problem where the old solution that we've been doing for the last few years, where sovereigns repay Northern European bank creditors, that doesn't work. The sovereign balance sheets of the South can't handle it anymore. The sovereign voters of the South want a different deal. Now, the solution, at least in the near term, for Greece is relatively simple. If you look at a little game theory Everybody loses. The positive sum outcome is Europe lends a little bit more money to Greece. Greece doesn't default, and maybe it'll term out the debt a little bit further. They'll reduce the interest payment a little bit more. But everybody gets to maintain the fiction that the headline value of that debt, the nominal value of the debt that Greece now owes to Europe and the IMF, won't change. It's a fiction we can tell Northern European voters to make them feel a little better. It also preserves a lot more value for Northern European creditors than a hard default does. This is a win-win. And, you know, I've been following the European Union for quite some time. I'm an American, in case you can't tell by the accent, been in London for 18 years now. Europe is good at crises like this. They're good at finding the positive sum outcome. The government officials in Brussels, they're technocrats. They want to find the best way. This is what they do. They're good at it. And I think skeptics and the bears on the current stock market are forgetting that. There's a big story around in the local press that people are saying that Greece is going to choose to exit. The choice before the Greeks is exit the euro today, see your living standards fall by half, and then hopefully growth will resume. So best case, say Greek living standards post-devaluation rise by 7%. It'll take a decade. It'll take a decade before the Greeks return to the living standards they enjoy today. It's a lousy trade-off, and it's hugely risky. So it's no surprise that when you look at the Greek polls, they're saying that 80% of Greeks want to stay in the euro, and they want to renegotiate the terms. There's a positive sum outcome here. Europe can renegotiate the terms, extend the maturities, reduce the coupon. We maintain the fiction that the nominal value, well, that the value is the same because the nominal value is the same. And Greece gets some NPV relief, and Greece also sees some near-term cash flow relief. It's a better outcome for everybody, and I think we're going to get to that pretty soon. As we do, stock markets can rally. As we stop worrying about every single headline in Spain, every single poll in Greece, every single bank depositor in Italy, we can see stock markets rallying, and that, I think, will be a big positive. Now, the other problem, and we had a bunch of economists up here earlier, which was kind of fun. The bigger problem that nobody really talks about is the growth slowdown. So it's not just about the south of Europe, it's Northern Europe that's slowing down. So you look at the chart on the top over here. This is the economic surprise indices. The blue line is the US, the gray line is Europe. It's no surprise that both are negative and still falling. These economic surprise indices basically tell you how are financial markets trading on the release of economic data. They're trading badly. Economic data is surprising us to the downside. That's a problem in Europe. We kind of know that, though. I mean, you don't wake up surprised and think, Europe is slowing down. You see it every day in the data. You see it. That's how Eurostoxx is trading. The bigger problem that we sort of haven't talked a lot about is the US is also slowing down. That's what this economic surprise index tells you in the US. It's a quantitative way of telling you the last couple of employment reports were lousy. It's a quantitative way of telling you that a lot of people earlier in the year were thinking the US was sort of a 2.5% to 3% story, and now people are saying 2.25-ish, maybe. Now, in Europe, with the slowdown and the weakness in Eurostoxx, that makes sense. But in the US, the S&P peaked at 1,400, and we're trading now about 1,325. Not a lot of downside priced in there. So I think stock markets have to see this as somewhat of a risk. We need to see better US data to rescue the 2.5% to 3% crowd. And, you know, this Friday we'll get another employment report. We'll get another round of PMI data coming out on the 1st. It should turn out better, but stick around. We got to wait and see. Now, the third of these four factors is China. And this is a fabulous chart. I mean, First of all, most people don't understand it, so I look incredibly smart because, well, I put it up here. But really the way to look at this is cement consumption per capita on the y-axis, and it's GDP per capita on the x-axis. What it shows you is China, top left. China is using more cement per capita than anybody has ever in the entire history of cement. And that's a pretty long time. What does it mean? Like, what do we do with this info? Well, the big story in China is that fixed asset investment is slowing down. And I think the Chinese bulls will tell you that, well, you know, it's still a poor economy, there's still a huge amount of growth. Still, China's using more cement than anybody ever, no matter how wealthy they were. It also gives you an idea of the potential magnitude of the slowdown. Look at Korea and Taiwan. They're the blue X's and the red triangles. Look at how far how much cement usage fell from the peak in the mid-90s, the peak of the Asian bubble, to where they are now, massively. It tells you that as the Chinese economy rebalances, and remember, this is what their leadership is telling us they want to do, they want to rebalance, they're telling us they want to move from sort of top left to kind of middle right. They want to get richer, but they're probably not going to continue to pave over every single square inch of agricultural land. The important thing is that the Chinese model is changing, and the important thing is they need new government policies to get growth going. Now, leaving the pretty picture in competition,